Why is a boring steel company outperforming high-flying tech stocks in capital efficiency? Welcome to the HDIN Research deep dive into Hill & Smith's FY 2025. While most investors are chasing the next AI shiny object, this infrastructure titan is quietly vacuuming up cash from the U.S. power grid. We're dissecting a strategic masterclass in geographic arbitrage. Think of Hill & Smith not as a manufacturer, but as a toll booth operator for the modern world. They provide the safety gear everyone is legally required to buy, but no one wants to think about until it's missing. If you look at this report and see a UK company, you've already lost the trade. The real story is a radical bifurcation of reality. On one side of the Atlantic, we have a stagnant UK economy. On the other, a US infrastructure gold rush fueled by federal billions. This isn't a balanced portfolio, it's a controlled migration. Hill & Smith is essentially a U.S. growth engine wearing a British tuxedo to the London Stock Exchange. It's like having one foot in a glacier and the other in a volcano. Luckily, they're leaning heavily toward the heat. Numbers don't lie, but they do scream. Look at the blue line. U.S. revenue is up 6% on an organic basis. Now look at the red dashed line. The U.K. is down 6%. This 12% delta tells you everything you need to know about where the management is sending the next dollar of capital. The UK road barrier market is currently a waiting game for government funding, while the US grid is a take-my-money scenario. In short, the UK is the anchor, and the US is the jet engine. You don't want to be the guy holding the anchor when the plane takes off. Why is their margin so resilient? Because they sell low-cost, high-criticality components. A road barrier is a rounding error in a billion-dollar highway project, but if it's not there, the road doesn't open. This is the ultimate defensive moat. Being too small to cut, but too important to ignore. They are the seatbelt of infrastructure. You wouldn't haggle over the price of a seatbelt while the car is hitting a wall, and that's exactly how Hill & Smith maintains its pricing power during inflation. Let's get granular. The UK's RIS3 road strategy is stuck in bureaucratic purgatory, delaying projects and eating margins. Meanwhile, in the US, the onshoring trend is real. Semiconductors and data centers need power. And power needs steel supports. The Atlantic isn't just an ocean anymore. It's a filter separating maintenance-only economies from growth-at-all-costs markets. Hill & Smith is simply following the smell of fresh asphalt and high-voltage cables. Proprietary engineering and operational scale. That's CEO speak for, we own the high ground. In a world of commoditized steel, Hill & Smith is selling specialized solutions that competitors can't easily replicate. This quote isn't just corporate fluff, it's a warning to anyone trying to compete on price alone. When they talk about, quote, capital allocation, they mean they are done subsidizing low-margin legacy businesses. If a unit isn't printing money, it's out. Margin expansion in a high-interest rate environment? That's the McKinsey touch. By optimizing the portfolio, they've managed to squeeze more juice out of the same orange. We're moving past revenue growth into quality of earnings. It's the difference between a bodybuilder's weight and a powerlifter's strength. Hill & Smith is getting leaner, meaner, and significantly more profitable. Look at that 26% margin in Galvanizing. That's not a manufacturing margin, that's a luxury brand margin. Galvanizing is the secret sauce here. It's a high-utilization, local monopoly business. Compare that to the 8.7% in the UK. The UK segment is basically the salad you have to eat so you can get to the steak, which is the US engineered solutions. Investors are paying for the steak. The salad is just taking up space on the plate. 79% of the profit comes from the US. Let that sink in. For every dollar this company makes, nearly 80 cents come from Uncle Sam's backyard. If you're still valuing this based on the FTSE 250 average, you're looking at the wrong map. Hill & Smith is a US infrastructure play that happens to be listed in London for the valuation discount. It's like finding a Ferrari at a used Honda dealership because the sign is written in the wrong language. Here is the raw data. The US revenue is nearly double the UK's, but the profit disparity is even wider. Note the strategic role at the bottom. The US is the growth engine, while the UK is in efficiency/recovery mode. That's a polite way of saying the UK team is fighting for survival, while the US team is picking out which new yacht to buy. This is the heart of the bull case. Data centers and the electrical grid. As AI demands more compute, we need more power. As we need more power, we need more transmission towers. Hill & Smith is the shovels and picks seller for the AI gold rush. You don't need to pick the winning LLM. You just need to bet on the fact that they all need to be plugged into a wall. They spent 2024 buying up the neighborhood. Trident, Capital Steel, FM Stainless. These aren't random purchases. They are bolt-ons designed to dominate specific local markets in the U.S. It's like a game of Monopoly where Hill & Smith already owns Boardwalk and is now buying every house in sight to ensure no one else can land there without paying a heavy fee. By 2030, this company wants to be net zero and fully optimized. But the real milestone is 2026-27. $46 million in organic capacity expansion. They aren't just waiting for the market to grow. They are building the capacity to swallow it whole. This is a management team playing 4D chess while the competition is still figuring out how to set up the board. 26.7% ROIC. In the world of industrial engineering, this is God-tier performance. It means for every dollar they put into the business, they get nearly 27 cents back every year. That's better than most hedge funds. This number tells you that their Atlantic pivot isn't just a theory. It's a massive wealth creation machine. It's not just a steel company. It's a high-yield savings account disguised as a factory. Onshoring is the buzzword, but Hill & Smith is the reality. By sourcing locally and ensuring dual vendors, they've insulated themselves from the next geopolitical tantrum. They've reduced debtor days to 59, meaning they get paid faster than almost anyone else in the sector. They aren't just managing a supply chain, they're weaponizing it to maintain their lead. Even Titans stumble. The $17.9 million impairment in the solar unit was a, quote, reality check. But look at the reaction. They didn't pray for a miracle. They closed the Garland facility and moved on. This is radical candor in capital allocation. They amputated the finger to save the arm. It's cold, it's calculated, and it's exactly what you want from a management team in a downturn. ESG isn't just about feeling good here. It's about operational efficiency. 19% reduction in emissions is impressive, but 91% of electricity on renewable tariffs is a hedge against volatile energy prices. For a company that melts steel and galvanizes metal, energy is a massive cost. Being green here is just another way of saying they're saving green. Look at these images. These aren't just products, they are the skeletal system of modern civilization. From the data centers that host your clouds to the barriers that keep you on the road, Hill & Smith is everywhere you don't look. That is the definition of a successful infrastructure play. If you don't notice it, it's working perfectly. If you need the full-page deep dive report on Hill & Smith or the broader infrastructure sector, you know where to find us. Email sales@HDINresearch.com or click the link in the description. This is HDIN Research, where we strip the fluff and keep the alpha. Follow @HDIN230 for the next deconstruction. Stay sharp.